Since we know that earnings yield kind of depends upon where the market is. But since earnings management always is very bad over longer periods of time tends to be safe. In fact, Schiller has a PE ratio. And the PE ratio, he named it cyclically adjusted PE or CAPE. No, this is Batman's CAPE, right? He defined it as price divided by, I'm going to call this E bar. E bar is equal to inflation adjusted average of earnings for the past 10 years. Normally, you would compare the case to the standard deviation, which is a trailing deviation. Let's kind of see what it is today. It is multi-PL. This is the, let's look at only the last 10 years. Okay. Currently, the S&P 500 PE trading equals 3096. That's actually a pretty high number. On the other hand, Schiller PE 4042. But as you may have realized, Schiller PE has a graph that is much smoother than it averages stuff. Averaging always smooths things. CAPE is backward looking. So you need to make an adjustment to make it forward looking. Remember, E bar, inflation adjusted in the sense that everything is expected in dollar terms for today's dollars, past 10-year average. So what you want to do is you want to basically take those and bring it to today. Okay? Take the average, essentially grow earnings from 10 years ago by 10 years. Grow earnings from 9 years ago by 9 years. The average years you grow is 5.5 because the average of numbers from 1 to 10 is 10 plus 2. Grow this for 5.5 years at the long-term growth rate of economy. Real growth rate. Because E bar is already inflation adjusted. So currently CAPE is 4042, right? Or let's call this E bar star now. I'm going to define a CAPE star which is price divided by E bar star. And you can write this as price And you can easily see that this is equal to CAPE divided by this number. And remember, forward-looking stable earnings yield is then one over CAPE stock. Currently, CAPE is 40.42. Real G, I'm going to take 2.5%. So this would be equal to not 442, 40.42. One plus 2.5% raised to the power 5.5. The whole thing divided by 40.42. Somewhat low, but in practice, I also kind of put a little adjustment to it. I typically use about 1.5%, so it remains to be the same. But for now, just leave it as it is, okay? So MRP or return on the market that you expect is 683, okay? Or deducting what you want to call risk-free rate 283. Now, independent of how many different ways you can estimate the cost of equity for a firm, these are all some sort of model expansion. Each model has pros and cons. When you have models that are acceptable in certain circumstances that are not, you can view them as different estimates. And you can go ahead and average those. Average of multiple estimates and throw is a much better estimate. Historically been the case. Let's go back to this NVIDIA page. I'm going to show you the range of estimates for next Wednesday's NVIDIA earnings announcement analysis. The average is 125, but it varies between 114 and 134. This is the average of 39 analysts. There have been studies done about this. If you can evaluate performance of the forecaster using criteria called root mean square. It's kind of a measure of variation of the forecast from the actual number. And follow these analysts over 20 years. Pick the best analysts out of this. Then create a made-up analyst. Consensus is euphemism for the average. The average performs better than the best of them. Why? Because each of these analysts have different pieces of information. Average kind of brings them together. The average knows a lot more about the forecasting and the individual elements. Let's stop here because the other class is about to come in. We'll finish up chapter 13 on Tuesday. More than likely, I'll finish what I'm going to say about half. Then we can do kind of an impromptu review session for the rest.